Today, we are initiating coverage on the underlying engine of global credit markets, focusing on the proprietary algorithmic credit scoring monopolist, widely recognized as the industry standard. This entity operates with a formidable economic moat, underpinned by regulatory entrenchment and high switching costs. Our thesis centers on its transition to a high-margin software-as-a-service model, driving significant operating leverage. With over 90% market share in consumer credit originations, the firm exhibits inelastic pricing power. We project a base case 12-month price target, implying a 15% upside, driven by B2B scoring volume stabilization and continued double-digit pricing growth. We rate this equity an overweight. The macroeconomic backdrop presents a bifurcated reality. While mortgage origination volumes have contracted by roughly 30% year-over-year due to elevated federal funds rates, the firm's top line remains insulated through aggressive pricing adjustments. Credit card and auto loan originations demonstrate resilience, expanding at a low single-digit cadence. The underlying market dynamic heavily favors incumbent scoring agencies, as the proprietary algorithms act as a prerequisite for asset-backed securitization. Consequently, even in a contractionary credit cycle, the firm captures a fixed fee per application, while mitigating volume risk through periodic structural pricing hikes on Tier 1 banking clients. Analyzing the revenue composition reveals two distinct but synergistic segments: scores and software. The B2B score segment accounts for roughly 50% of total revenues, generating exceptional EBITDA margins exceeding 80%. This is essentially a toll bridge business model. The software segment, conversely, is transitioning from on-premise licensing to cloud-based SaaS, currently demonstrating a compound annual growth rate of 14% over the trailing 36 months. Annual recurring revenue metrics in the cloud segment are accelerating, providing clear visibility into future cash flows and reducing cyclical dependency on pure lending volumes. The core thesis rests on the firm's monopolistic pricing power. Unlike commoditized data providers, this entity's algorithm is legally embedded into institutional underwriting frameworks and Fannie Mae or Freddie Mac guidelines. This structural entrenchment translates to zero churn among institutional clients, despite consecutive years of tiered price increases ranging from 10 to 25%. When the cost of a credit score is merely pennies on a $300,000 mortgage, price elasticity is virtually absolute. This dynamic guarantees margin expansion, even in stagnant volume environments, fundamentally differentiating the asset from highly cyclical financial services equities. Let us examine the profitability metrics. The transition to cloud-based architecture, while requiring upfront CapEx, is now yielding substantial operational efficiencies. Gross margins are stabilizing at an impressive 78%. More critically, the free cash flow conversion rate sits at a pristine 95% of net income. This robust FCF yield allows management to execute an aggressive capital return program, systematically repurchasing shares and structurally inflating EPS. Over the past 5 years, the total share count has been reduced by nearly 15%, an accretive maneuver that significantly amplifies shareholder value. From a valuation perspective, the equity trades at a premium, commanding a forward price-to-earnings multiple of roughly 38 times and an enterprise value-to-EBITDA multiple of 26 times. While optically expensive compared to legacy financial institutions, this multiple is justified when benchmarked against Tier 1 SaaS monopolies. Adjusting for growth, the PEG ratio sits at roughly 1.8. The market is pricing in the durability of the economic moat and the high visibility of SaaS recurring revenues. Our sum of the parts analysis assigns a premium multiple to the score segment, while valuing the software segment in line with enterprise cloud peers. Turning to the technical setup, the equity remains in a confirmed long-term secular uptrend. The 50-day exponential moving average has consistently acted as dynamic support during broader market pullbacks. Currently, the stock is consolidating in a tight bullish pennant, just below its all-time high resistance level. The relative strength index is printing at 58, indicating the asset is neither overbought nor oversold, providing an optimal entry window. Institutional accumulation is evident, with the on-balance volume indicator trending upwards parallel to price action, confirming strong conviction from large block buyers. A rigorous analysis mandates exploring the bear case. The primary downside risk is regulatory intervention. The Consumer Financial Protection Bureau has signaled increased scrutiny over monopolistic pricing in credit reporting. Furthermore, the Federal Housing Finance Agency has approved alternative scoring models for mortgage underwriting, technically breaking the decades-old single-score monopoly. Should alternative data models gain traction, pricing power could erode. In a severe macro recession where non-mortgage origination volumes plummet by more than 20%, we model a downside scenario of 25% from current levels, placing the valuation back at its historical mean EV to EBITDA multiple of 18 times. Conversely, our bull case projects a 30% upside over the next 18 months. This is predicated on the successful execution of international expansion strategies and hypergrowth in the B2C interactive segment. As emerging markets modernize their credit infrastructure, the firm's algorithmic standard is primed for export. Domestically, if the Federal Reserve pivots to a dovish policy, reducing the federal funds rate by 150 basis points over the next year, mortgage originations will finally rebound. Combining a volume recovery with the newly established higher pricing tiers would result in explosive EPS growth, expanding the multiple to 45 times forward earnings. In conclusion, this fintech giant represents a rare intersection of utility-like indispensability and software-like margins. While the valuation multiples screen as elevated, they are fundamentally supported by insurmountable barriers to entry, absolute pricing power, and an accelerating cloud transition. The risk-reward asymmetry favors long-term accumulation. For portfolio managers, we recommend a core holding allocation, utilizing near-term macro volatility and technical dips to the 200-day moving average to build positions. The structural integrity of its cash flows makes it an optimal defensive growth asset within an institutional equity portfolio.